question, you may or may not get part of the sort of space for the solutions laid out as well. So I won't make you read the whole PDF, but the sort of backdrop here is basically you're trying to build a three-way integrated model, meaning your income statement, balance sheet, and cash flow statement. And basically lays out, most of this is also in the Excel file, so we'll kind of skip through the PDF pretty quickly and then jump over to there. So it tells you, it's going to be an annual model, 10 calendar years, plus the starting balance sheet. You're looking at buying into the company, so it gives you the equity investment date when you think about valuation. What's year one, just all the kind of basic setup stuff. Assume all cash flows occur on the final day of the period, yada yada. And then it kind of gives you all the setup. This is all in the spreadsheet, so we'll kind of skip over there in just a minute. Here's the initial investment. We got this much cash, accounts receivable, inventory, property, plant, equipment, etc. Here's your assumption about revenues. It starts off at 25 million, and then it grows by a minimum of either 3 million a year or 8%. Assumption about COGS, assumption about expenses, takes you through everything. So you've got capital expenditure, depreciation, debt, working capital, distributions if you have excess cash, etc. So this is like a pretty small model. I mean, this was like a 40-minute question. We'll, I don't know, take plus or minus that length of time to actually go through and build it. But I mean, don't focus too much on the actual. Don't focus too much on the actual mechanics of it. What I really want to talk about is the model setup and how you think about sort of best practices for this stuff. So, a couple of things that are kind of really important right from the start. As you think about how to build a sort of professional standard financial model, one kind of good practice that's already built into this up front is state your assumptions very clearly and preferably separately. So like this one actually has a specific separate number format, like this yellow box, blue text means this is a user variable assumption. And so if I pick up this model tomorrow and say, hey, how would the value of this company change if sales started off at only 20 million, but they went up by at least 4 million every year, and COGS, let's say we could bring that down to 55% by making some rationalizations, and let's say that we can slow down expense growth to only 6%. If I make all of those changes, what's the value of the company now? Super important design principle is that these should be kind of laid out and visible in a cell by themselves, kind of typed in. That's step one. Step two, they should only ever be entered in one place. So in other words, if your expense growth rate is 7%, you don't put 7% on your assumptions page and then also type in 7% in your calculations. Just unbelievably important, because if you have it in one place and everywhere else you need to think about expense growth, you refer back to that formula, then it means that your expense growth is always consistent throughout your model. Very important. If I type in 7% here and then go over to wherever it is, go over to modeling expenses here and say, whatever it was, year one is 3 million, and then I say equal that times 1.07. I copy it across. Type some stuff here because this screen is not huge. Get some things out of the way. See a little bit more of it. If I do that, and then somebody else comes in tomorrow and says, hey, what if I can get expense growth down to 6%? What will that do to the value of the company? The answer is absolutely nothing, because in here you've still written 1.07. And look, we've probably all been guilty of it at one time or another, of kind of thinking, I'll remember. It's no big deal. If I change the expense growth rate, I know I have to change it in two places, it's fine. don't do that. Like, very emphatically, don't ever do that. It's terrible practice, and this is begging